Hello, listeners, and welcome back to another episode of Cognitive Dissidence. As usual, I'm your host. I'm Jacob Shapiro. I'm a partner and the director of geopolitical analysis at Cognitive Investments. Before we get to my weekly chat with Rob, just a reminder that we have rolled out the CI Perch Knowledge Platform. So if you are a wealth manager, an institutional investor, a corporation, and you want more access to the research, geopolitical, and innovation insights that we talk about on these podcasts all the time, please reach out to me at jacob@cognitive.investments, or you can check out the research page on our website online at cognitive.investments. Otherwise, it has been an absolutely crazy week in geopolitics and markets. It may not feel like that because I feel like a lot of the things that are happening, they're not, I shouldn't say important enough because they're very important, but they haven't really hit those topics that usually hit the front pages. But sort of on page 2 through 10, what is probably in your newspaper, it has been an incredibly busy week, both in geopolitics and markets. So Rob and I do our best to track through all the things that are going on. Listeners, if you haven't left a rating or a review of the podcast, please consider doing so. It helps us immensely, and it just takes a couple seconds of your time. Otherwise, you can reach out to me at jacob@cognitive.investments with any questions you have about our wealth management services, about those research services that I described before, or just about anything else that is on your mind. So otherwise, cheers. See you out there. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. All right, listeners, Rob is joining us on a French holiday. He could be out on the streets of Paris right now, sipping espresso or Aperol Spritz or something else, but instead he is sitting here staring at my recently shaved, but still, fit for radio face here on the computer, talking to you about geopolitics and markets. And it's nice for me to see you, Rob. I'm glad you're spending your time with me. I think I'm getting the better end of the bargain.
Well, as I said before, I think if I took all of the French holidays, then I wouldn't be here like 30% of the time. It's probably not going to work.
Well, it's a very American attitude, though. It seems to work for the French just fine. Like perhaps you would work even harder, more productive. Did you see the UK is like piloting a 4-day work week? I mean, that sounds beautiful to me. But
it does sound good. I have to say, I do get some looks because you can't really see, but in the office that we share here in Paris, there's a big glass window looking out into the courtyard, and everyone who walks in can see that I'm here working on the holidays and often on the weekends and stuff. And I get some very strange looks from people trying to wrap their heads around that.
Well, we appreciate you at least. Do you know what French holiday is it? What are they celebrating today?
I was told that it's the Assumption Day or the Feast of the Assumption, but then I looked it up and that says it's in August. So I don't know. Something on a random Thursday.
Oh, we should all be so lucky. Well, I honestly, listeners, I'm a little out of sorts this week because I guess the world didn't get the memo that last weekend was Mother's Day and you were supposed to be chilling and hanging out with the moms and not doing crazy geopolitical things. But it's not like anything huge has necessarily happened, but there was so much stuff happening around the world. I mean, Argentina is descending into hyperinflation. There's fighting in Libya again. There's a civil war in Sudan. There's the Russia-Ukraine war. There's Turkish elections and Thai elections and an India regional. Like when you start going down the list of things that have happened in the last 5 to 6 days, it's exhausting. It's been exhausting for me to keep the knowledge platform relatively up to date with just all the things. And it also means this is one of those weeks where, usually during a week, I know immediately, okay, there's 1, 2, maybe on a busy week, three things that I know I need to dive into deeply and understand a little bit more. And then I come here on Thursday or Friday and I have hot takes and interesting things to pepper you with. This week, I'm holding on for dear life. Like I feel like I'm trying to get as close as I can to insight on a bunch of different things, but I feel inherently insecure about where I'm at right now. The funny thing is, though, Rob, we were talking before we hit the record button. You're sort of feeling that way in markets too, right? It seems like there's also a lot of just movement and churn happening in markets. So as usual, why don't we start with the markets, and we will back in to as many of these geopolitical issues as we can, with the proviso that if you really want the sort of roundup, I'll be spending most of the rest of today after we record and tomorrow fixing the knowledge platform and diving deep and putting together the sit rep, which at the rate this week's going, it might be 10,000 words. But let's start, Rob, with sort of where you're thinking about markets from this week, because there's a lot going on.
Yeah, and we've been more than usually active in markets in the last 2 weeks, putting on positions, closing others, sizing things down, sizing them up. So it's been a pretty busy time. So what's going on in markets? Some pretty big stuff, actually. So the equity markets and the interest rate markets and the currency markets, you have to kind of break out those three things. So in the equity markets, stocks haven't really been doing much of anything for quite a while here. Like, the last 6 weeks, they've been kind of bouncing around sideways. That is open for question whether that's going to continue now. So the S&P, as I'm writing this, is trying to break out to a new high. And the NASDAQ has broken out to a new high. And, a lot of the discussion now is, is this going to hold? Is this the start of, a rip your face off rally? Because everyone has been fairly negative on equities. And there's a lot of people concerned that they're going to get caught out. So that's happening. And how do you deal with that? And at the same time, sort of an interesting divergence is we've talked a lot about interest rates. We've talked a lot about currencies here. Well, both of those things are sort of moving in the way that we predicted, I guess, at least positioned for. Predictions don't matter for much; it just matters how you're positioned. Yeah. So the euro has been really declining against the dollar in the last week or two, pretty sharply. So the dollar is seeing a resurgence after being on the mat for most of the last 6 months. And then at the same time, interest rate expectations are coming up again pretty sharply. So just today, I was going to say euro dollar futures, but that's not a thing anymore for the geeks in the house. Now it's SOFR futures, but interest rate futures, the cost of borrowing dollars in the futures markets, that's gone up by 15 basis points in just the last few days. And that doesn't sound like a lot, but to put that in another way, the implied probability of a rate increase in June just went from 28% to 40% in a few days. Mm-hmm. So some Fed board members have come out and sort of made hawkish statements saying that they're really not seeing the data slow down quickly enough, things like that. So rates going up, bond yields going up, the dollar going up, and equities, hard to say exactly, look like they want to break out. And if they do, that would be like bizarro world, because previous to today, over the last year, stocks and risk assets have moved in the opposite direction. So when the dollar has gone down, stocks have gone up. When rates have gone down, stocks have gone up. Now we're seeing the opposite. So it sounds subtle and kind of silly, but if that relationship should flip, that would be a big deal for markets. And I think I'm a little skeptical that it is going to flip, but it's something to watch if you're a market watcher, because all of these things have implications for broader macro and what's going on.
Yeah, and I always like to talk about Japan on this podcast, because even though everybody thinks, Warren Buffett and everybody else who's now talking about how they're bullish Japan, you can go back to the archive here. We've been bullish Japan for quite a while. But in the context of everything you're talking about, the yen weakening pretty significantly against the dollar sort of this week. We're now flirting with 140 again. Japanese stocks are up, and so now Bloomberg can write that easy headline that the Japanese stock market is finally reaching back to 1990 highs. So if you bought in 1990 and held until now, congratulations, you've made all of your money back. But I thought that was interesting too, not least because Biden canceled his staying around at this G7 summit, blah blah blah, for a meeting of the Quad. But he met with Kishida today, and the United States and Japan continue. It's hard to sort of think about countries that could be any closer politically or on a security basis and things like that. But it looks like Japan and the United States continue to talk about the ways that they're going to partner on semiconductors, the ways that they're going to partner on security issues and things like that. So just an interesting dichotomy, and I think fits with some of the things that we've been talking about here for a while. Rob, I know that there was also a divergence we were talking about in our research meeting yesterday, where we were talking about copper and bonds and soybeans and things like that. And I know there was also an interesting divergence that you brought up there. I don't know if we have an answer to the question, but maybe that's also something to just put in the minds of the listeners.
Yeah, I mean, I think the issue there is that copper prices have been rolling over, in part because people are becoming more pessimistic about China and its recovery.
Yeah.
And that's been happening. Other sort of measures of cyclical growth have been rolling over and weakening, like foreign currencies, for example, which have moved very similar to copper. And yet, bond yields are not doing the same thing. Interest rates are going up, and bond yields, longer term bond yields, are also going up, which is a big change, because a lot of people, remember we talked about 2 weeks ago, a lot of people were buying bonds. It's a very consensus trade to buy bonds because people think we're heading into a recession of some magnitude. How big it is open to debate, and that interest rates are inevitably going to be cut as a result. So that's an interesting divergence, because they call it Dr. Copper, as everyone knows, because it's viewed as sort of this measure of cyclical demand. And copper prices are rolling over, but bond yields are not following them. So that's an interesting divergence in itself. And what does that say about the future direction of interest rates and the U.S. economy? I'm not certain.
Well, and again, there's also geopolitical intrigue to add to this as well, because I think this is probably going to get lost in a lot of the things that have happened this week. But when I got to work Monday morning and was doing my reading and catching up on the weekend, the most interesting thing that I read was it was an op-ed in the Washington Post by David Ignatius. And the reason that that's important is because the Biden White House, and Joe Biden in particular, he's very old school with the way that he uses media. So there are channels that the White House likes to leak to. There are journalists and columnists that Biden likes to talk to. He likes to set the agenda that way. He's sort of in his mind living in a world where the New York Times op-ed page still really, really matters, rather than Twitter and Reddit and everywhere else people are getting information. Podcasts like these, things like that. And the reason it was so interesting was because Ignatius was offering some detail about a previously unannounced conversation between Jake Sullivan, the national security advisor, and I forget which Chinese top foreign official it was. I think it was Wang Yi, but if I'm wrong about that, it was another one. But apparently they met in Vienna and they were talking, and according to both sides, it was constructive. It was pragmatic. They talked about the Taiwan issue. They talked about China's tacit support for the Russia-Ukraine war, and they did all this without throwing up their arms and leaving the room. They talked for hours, apparently. And again, those words, pragmatic, constructive, that's about as effusive as U.S.-China relations get right now. And it's a big deal because really, Sullivan was supposed to have this conversation back in February, but we had the spy balloon gate thing. Then before that, it was, maybe summer of last year, things were going to get better. Then Pelosi went to visit Taiwan. And all of that is to say that, it's this little tiny sign that maybe U.S.-China relations are getting a little bit better. And then the real kicker in the op-ed, and the reason I thought the op-ed was so interesting, was because the penultimate paragraph said, well, it looks like Biden now has decided that he doesn't want to play a part in starting or continuing a U.S.-China Cold War, that he thinks that would be bad, and that he has sort of not... I'm paraphrasing here, but basically that he had not really staked that position out, and that there was internal dissent within his government between China hawks and China doves, and he had just sort of sat on the sidelines, and the hawks were winning the argument. And the point of the op-ed was basically Biden doesn't want a Cold War between the United States and China. Now, as we say back in Georgia on the farm, the horse is already sort of out of the barn door. It's sort of a little bit like sour grapes to be talking there about that right now, but that's a huge, if that's true, if that's what Biden really thinks, and he's going to spend the next 18 months trying to make sure that there isn't a Cold War between the United States and China, I mean, it's a bridge too far to say, oh, we're going to get tariffs taken off, or, oh, U.S.-China trade relations, maybe they're going to get repaired a little bit. There's still all these structural issues in the relationship. And, the yuan, I think, was weakening this week as well against the dollar, down past 7. And that's, that's going to cause problem with trade and domestic political problems for Biden, all these other things. But, for the first time, since literally around this time last year, we can say some positive signals in the US-China relationship, which, any small signal is a good thing, but it also cuts against, everybody was expecting the China COVID reopening to be great. Now it's not looking so great. But man, if you got even incremental progress in US-China relations, I feel like that would be a good thing, even if it's hard to imagine there.
I mean, all else equal, it would definitely be a good thing, but I think it depends on what precipitates it. So again, rooting things in markets, the Chinese yuan touched 7 against the dollar today in the offshore market for the first time in quite a while. Mm-hmm. That's a little bit of a worrying sign. At the same time, I saw Brad Setzer had some good analysis of the trade data, and he pointed out that the Chinese current account, if you look at kind of where seasonal adjustments would take you and stuff like that, it's hitting new highs. And we've talked about this in the past, how there's been no rebalancing. The current account in China has widened into further and further surplus despite everything. And for those who don't know, so the current account is basically the trade surplus. So China has a bigger and bigger trade surplus, exports more than imports. That's not a good sign. If China were really healthy, you would be seeing imports improving as they import raw materials and things like that to support investment, leaving the whole kind of rebalancing thing aside. The other data point that I think is worth noting is, we've talked about Chinese junk bonds here on the podcast a few times, which seems like a wonderfully esoteric area to be looking at. But I think it's an interesting indicator because Chinese junk bonds have tracked the whole China narrative over the last 12 months. And I remember around Thanksgiving when people were saying, oh, China's going to reopen, they're going to announce it soon. And then they did. Well, Chinese junk bonds were there ahead of time, sort of ripping in advance of that. And we talked about this recently because junk bonds were sort of coming off the boil a month ago. And now the update there is that the prices of Chinese junk bonds has been hitting new lows, new short-term lows. So something's wrong. There's something amiss in the Chinese junk bond market. And there's, a fair amount of property developers in there. But it's also more broad. It's not just the property bonds that are getting hit. So despite the narrative that the property market in China is stabilizing, things look okay, that's a big tell. Something in Mr. Market is disagreeing with that. And all of those things are sort of signs of impending weakness. It's certainly not a sign of strength. So that might be influencing some of this willingness to mend fences.
Well, and you were talking about the China, the trade surplus. The corollary of that is that the United States and other countries that have trade relationships with China, they run a trade deficit. And my point just there is that China can do all the rebalancing it wants, but unless Xi Jinping is really willing to go full Mao on the Chinese Communist Party, which he hasn't been willing to do yet for all of his authoritarian tendencies, he's sort of fighting an impossible battle. He can push the boulder as much as he wants up the hill, but if there isn't a reset of the global economy, and if the United States isn't changing the way that it's doing things, then there's nothing that China can really do because the global economy is set up that way. And China has its role to play as it has the surpluses and it makes the good, it manufactures the goods and it assembles things. And the United States provides the capital, it provides the tech, and all the things get assembled all around the world. That's the way the economy works. And part of the problems we're having in the economy is that politicians and leaders in all these countries have been saying, no, we don't want things to work that way. We want security and geopolitical sovereignty and things like that. And the flip side of that is if you do that, you have to basically rebuild the global economy. You have to rebuild trading lanes and things like that and trade routes. And I've been thinking that maybe the United States and China and some of these other countries will look at each other and sort of realize, hey, yes, we're on a long-term trajectory for conflict, but if we try and have this conflict now, it's going to suck for everyone and nobody's going to win and there's going to be nothing decisive. So that's one of the reasons that's so important. The other, before we kind of close this section of the conversation, we've been very ambivalent about India on this podcast before. and even in terms of positions at CI, I think we've also been fairly ambivalent. Every time India comes up in our strategic wealth conversations, I'm crumpled in my chair trying to figure out what I'm supposed to say. We had a short position for a while when Indian equities were super high. And I just want to note that I think because India had that regional election, Congress Party won. Congress is the opposition party against BJP. I'm not saying that Modi and BJP actually faces a real challenge in 24. I don't think that they do. But when you start to put together some of the stories about India in the last couple of weeks, Tim Cook went there and talked up India's big potential. A couple weeks later, you get that India is rolling out a $2 billion drive to have laptop makers come to India. They're talking to Apple right there. Apple's going to start making iPads in India soon because of some tax deal that they made with the Indian government. There's that. Amazon announced $13 billion of investment in India this week. I saw that on Channel News Asia when I was watching this morning, feeding the baby. Even Warner Brothers Discovery, which is in our equity strategy, they've announced some big initiative in India. They want to be like the entertainment giant of India. And all of which is to say that I think all of these American companies, they sort of get this idea now that access to the Chinese market isn't going to be there for them. And they have to find other markets of scale. And the only market with that kind of scale is India. So at least, here on May 18th, Ambivalent Jacob is a little more positive on India, not because of anything the Indian government is doing. If anything, the Indian government is getting in the way of lots of these things and the reforms it hasn't been pushing and like all these problems. But it almost seems like India is going to succeed in spite of itself just because, all these American companies and Western companies that want to divest from China in the long term, India is sort of the only game in town for them if they want a country with similar scale, if they don't want to do the hard work of piecing together, opportunities in other markets.
Well, the other item that you didn't mention was the sort of quasi Belt and Road announcement that the U.S. made with the rail links through Saudi. Why don't you speak to that as well? Because that's an interesting sort of state-led initiative, which is a little bit different from what we've seen.
I didn't see an announcement about that, but I think it was Axios that reported it. And it's really, the U.S. is participating in it, but it sounds like it was sort of this Saudi-India initiative, and Israel was really egging it on because they wanted to connect, the subcontinent to the Middle East. But it was about trying to build infrastructure and trains and things like that would connect the Indian market to the Middle East. And there's plenty of geopolitical and historical precedents for that. If you go back in time, in the course of doing research on the dollar as a reserve currency, you find interesting moments in history where even when the pound sterling was the reserve currency, for example, there were portions of East Africa and the Middle East that used the Indian rupee. Now, the Indian rupee had a relationship to the pound because of the British Empire, all these other things. But the point is just that, when India is playing a major economic or strategic role in the global economy, it's subtle, and it's subtle especially because India is a Hindu country, and the Middle East and large parts of these areas are Muslim, so there's lots of tension there. But India does become a center of gravity for the Middle East from an economic perspective. In some ways, I think this is why China is being so aggressive, because they have a lot longer to go and much longer sea lanes that they have to patrol in order to get to the Middle East markets like that. India doesn't really have to do that. Now, the flip side of that is you still have to go through Pakistan, you still have to go through Afghanistan, you still have to go through Iran. So there's plenty there that it's not exactly a cakewalk or anything like that, but you can see in that this vision of trying to connect some of these regional markets, and India being this player that really could be the engine for a Middle East economy, because the Middle East really doesn't have that big population consumer center that it needs to do that sort of thing, or the manufacturing capacity to become Mohammed bin Salman can talk about Vision 2030 all he wants, but the Middle East is going to have to augment that somehow. But yes, when the thing with India, and this goes from a domestic level, it goes to a foreign policy level, like India knows exactly what it needs to do. It's always known exactly what it needs to do. If you just read Indian think tank reports and Indian government reports, you would think this country, it's on the way. It knows what it needs to do, and it's going to execute. The problem with India has always been execution. It can see what it needs to do, but it can never get out of its own way to actually sort of be that more central player in all of these realms. And I still, even with some optimism here about India, I still don't see that. You're still going to need a Saudi Arabia, an Israel, a United States goading them on, saying, here's the capital, here's the impetus, here's what we're going to do. It's harder for me to imagine India actually being the one to make those moves. The ironic thing is, India wants to do that, but what I'm saying is the reason to be optimistic about India is not, it doesn't have anything to do with Indian government policy. It has to do with a billion young people in a world that is used to having a market of a billion plus people for labor and consumption and all these other things, which is getting increasingly more tenuous.
And speaking of Pakistan, do you want to shift gears and talk about what's happening there?
Yeah, we can shift gears a little bit. And, with the proviso that I am not a Pakistan expert, and I'm actually recording with Kamran a little bit later today. I'm not sure exactly when we'll push that episode out. So we'll go a little bit deeper we'll go much deeper, I should say, about Pakistan with Kamran. But sort of not off the cuff right now because we've been following this very closely. But sort of the big picture here is that cricketer superstar Imran Khan became Pakistan's prime minister a couple of years ago. Like most Pakistani leaders, he eventually clashed with the Pakistani military. Also, Pakistan had an economic crisis. It had that horrific flooding from last year. Pakistan was one of the real losers of the European energy crisis because Europe went out and bought a bunch of LNG at spot prices and higher prices, and nobody wanted to sell to Pakistan because Pakistan didn't have the money. They had a balance of payments crisis going. They also had very high food prices. And even as you start to see inflation come off the boil in lots of parts of the world, the latest reporting out of Pakistan is record high food prices. Cooking oil, electricity. We're talking 47%, 50%. Annual increases, and it was already coming from a fairly high level. So when you put all of that together, populist leader challenged by nefarious intervening military with a population of 200 plus million people who are facing natural disasters and heat waves and rising food costs, like you put all those things together, it's a real pressure cooker. And what's happened the last couple of weeks is that it's all come to a head. So Imran Khan was booted from office, and he's been doing stuff here and there, protests, but nothing that's really risen to that important. But there was basically a warrant was issued for his arrest. I guess that was last week, and he was arrested and thrown in jail. And the charge was that he wasn't willing to show up to address an investigation into corruption under his premiership. Now, there were clashes between Pakistani protesters and the Pakistani military. There were even reports that protesters were attacking Pakistani military installations. That's a crazy thing when you think about it. The Pakistani Supreme Court came in and said, you shouldn't have detained Imran Khan. He should be released. He was eventually released last Thursday, I think, or last Friday. The latest news here today, it's Thursday, May 18th, this will come out tomorrow, is that police have basically besieged his house. And they're waiting for him to come out because he still has not answered the summons looking into corruption in his government. I have no idea whether the allegations are true. Probably they are, but probably every Pakistani leader is guilty of corruption. Obviously, there's something being politicized here, and the Pakistani military is not happy with him. But the last sort of piece of context to keep in mind here is that right now, Pakistan's actual government, it's a largely technocratic government, which its entire its basic goal right now is to work with the IMF to get IMF funds to prevent this balance of payments problem becoming a crisis, an economic catastrophe, to prevent 50% inflation from becoming hyperinflation, because that's really what's at stake here for Pakistan. So it's not a market we talk about very much. I think there's one ETF out there if you wanted to play like with Pakistan in general. So probably a lot of investors that are listening to this podcast aren't going to be paying attention. But, it's, again, a country of 200 million plus people with nuclear weapons in a fairly volatile region in the world, astride key, strategic trade routes. It plays into the whole U.S., China, India triangle. It's something to be watching very, very closely, even if it's not, making the front page in lots of Western media right now.
And one area where it does have a lot of market impact is in food prices, as you mentioned. Mm-hmm. So
food and cotton.
Food and cotton, that's for sure. So in full disclosure, we've had a short position in soybeans, which we talked about a while ago here. We've closed about half of that, our tactical macro strategy. And we just put on a position yesterday in wheat, which we've kind of toyed with in the past and gotten stopped out. But we're back into that. And part of this is a Pakistan story. So first, before talking about wheat, I think we have to talk about rice, because almost all food prices in the world right now are rolling over. At least all the grains are. Beans, wheat, corn. But rice is doing the opposite. So rice prices are having quite a bull run here, and they just made a multi-year high. So why is that important? Supposedly we're talking about wheat. Well, the issue with rice is that it's a substitute for wheat. So you see a lot of substitution, especially in poor countries in Africa, Central Asia, places like that, where they'll switch back and forth between rice and wheat, depending on the relative prices. So rice prices are really ripping, and in large part, a big part of that is because of Pakistan. Pakistan is a major producer, a major exporter of rice. They've just been having problem after problem with their rice crop, on top of just general economic disarray and high cost of capital and currency devaluation and all those things that just cause havoc with producers. They are experiencing flooding again. And then last year they had the catastrophic floods that really threw things out of whack. So they're having major problems, and the price of rice in Pakistan has absolutely soared, and that's contributing to broader increases in rice prices across all of Asia and the world, really, because it's a global market. So it's an interesting area. No one's really talking about it, and part of the reason why it is interesting is because everyone is sort of thrown in the towel on wheat now. The conversation seems to be dominated by talk of Russia's enormous wheat crop that they're getting rid of, the fact that the Russia-Ukraine deal has been extended. I saw a piece on Bloomberg today where some broker in ag was saying something like, there's all the risk premium has been taken out of wheat now. Like, there's no reason to ever own wheat because everything is coming up roses, which is usually exactly when you want to start looking at things and getting involved. But this is one area that no one's really talking about, the impact of rice and the potential for wheat demand to go up as a response, because you actually saw the opposite a year ago when rice prices were pretty low and wheat prices were still very high. You saw a lot of demand in Africa, for example, substitute or shift away from wheat and back into rice. You could see the opposite today, and that's a pretty big deal.
Yeah, no, there's a couple things I would say. That the first is, you're right. I mean, nobody's paying attention to this. There are a few people who were talking about this out here, and I can't remember if Dan Bass said this on the podcast, or if I had him on the podcast and then he said this in the presentation that he gave when he and I were both speaking at a dairy event last November. He sort of talked about how, last year the concern was we were going to have the sort of global type Arab Spring phenomenon because food prices were spiking the way that they did in 2008 and 2009. And it wasn't just in the Middle East and North Africa, which had a drought around then. And that's why you had the Arab Spring where it was and how it worked, but that it was happening globally. And just as an aside, when we say global food prices are rolling over, we're rolling over from record highs. So it's not like, relative to the baseline, they're suddenly back to normal. They're still very elevated. It's just that they're rolling over from those top highs. But Dan mentioned, the thing that prevented the world from really having that global food crisis last year was rice. Rice was the hero last year because as the Russia-Ukraine story went on, and corn and wheat and all these other things, you were getting volatility and there was concerns about supply and there were rice actually had a really great year, and there was a lot of rice supply. And when you started to look at Southeast Asia and parts of the subcontinent and places that are dependent on rice, they didn't experience that. So even though you had some of these disjunctures, by the end of the year, you had the grain deal in place, you had some kind of, not an end to the Russia-Ukraine war, obviously, but people got used and accustomed to the Russia-Ukraine war. Those risks got priced in, and rice was the hero. So when you say that now rice is not the hero, that rice is now sort of taking it on the chin, I think that's really concerning, especially comparing it with last year. And this is also maybe the point that, we're 30 minutes into the podcast. Shame on me for not saying, we still have the Russia-Ukraine war going on. We're going to post a podcast on Monday with Sim Tack talking about the upcoming Ukrainian counteroffensive. The war is about to reach probably its most active and kinetic phase since the war started originally. And I think everybody has gotten accustomed to the idea, there's this war in the background and it doesn't really affect me, and we've got the Black Sea Grain Initiative. No, it's still the largest land war in Eurasia since, World War II, really. That's happening right now. And so that could also sort of feed into these developments. The other thing I would just say is, again, it's hard to generalize here because when we say food prices are rolling over, yes, but you've mentioned rice. Sugar hasn't been rolling over. Beef has not really been rolling over. If you go to the Tyson story and all these meat packers in the United States, that's another thing that Dan has talked about before. So you can find pockets in the market where food is not doing that. And I would point people to the U.S. CPI too. The last CPI, it was up 0.4%. It was 4.9% over the last 12 months. Energy was down, and all items less food and energy was a little over 5%. Food, though, was still leading the way. It's like 7-8%. So in general, like food, even in a place like the United States where inflation is coming off the boil, it's not the biggest contributor, but it's still like relative to energy and all these other things, it's where things are highest. And as people are probably tired of me saying this, but if you put me on a desert island and you gave me one indicator for what's going on in the world, like give me global food prices, that will tell me what's going on in the world. Because when food prices what's the right way to say that? When food prices go up, political volatility and political instability go up. And, to take it back to where we started here, we started talking about Pakistan, and Pakistan is extremely important, as you said, because it's a 200 million plus person plus country. They've had really big weather concerns. It doesn't look like this year is going to be any better to them. Hopefully they can avoid the floods. But this also goes back to something we mentioned last week, which is around the world in emerging markets, you have trouble. You've got a civil war in Sudan, and the UN World Food Program talking about what a big deal that is in providing access. You just had an Ethiopian civil war that only ended last November, and you had lots of food insecurity that was created around that. You've got a famine in, Somalia, the Horn of Africa, maybe one of the worst famines in recent decades. So when you start to put all the pieces together, maybe there's a lot of demand out there for things like wheat that maybe the world isn't quite thinking of. Because if you go to USDA and look at wheat, the first thing you're going to see is record production. Like we had record production last year. We're forecasting record production this year. The second page is, oh, by the way, we've also had record consumption last year, and we're going to have record consumption this year. And I think the bet about wheat is to say that consumption number, that record consumption number, all it takes is a Pakistan and a Sudan for it to flip maybe above where that record production level is. And I think that's the bet. And that's actually what makes this conversation, I think, different than when we first tried wheat earlier this year and stopped out. Because when we first tried it, we were thinking the Black Sea Grain Initiative was a little more tenuous than people were thinking. And we were trying to get into the minds of the Kremlin. And yet again, I was foiled by either the strategic brilliance or the complete sort of incomprehensibility of Russian strategic decision making. I should just stay away from any trade or any analysis that has to do with trying to anticipate Russian ideas. But right now, like that's not what this is about. The Black Sea Grain Initiative would be a steroid boost in the arm for the idea that we're talking about. But I think it is about Pakistan and these other places in the world that are important.
It's like the Princess Bride. Never get involved in a land war in Russia. Never get involved in a Jacob Shapiro analysis of Russian strategic decision making.
It's unfortunately heading that way. I mean, I feel like I've gotten most everything else right in the world for the last year or two, but I keep getting this one thing. It keeps on slapping me across the face. So I don't know.
That's all right. Keeps you humble. But on the food thing, I think this is an interesting thing to point out, just talking about how people analyze these food markets and the USDA announcements and things like that, which is people forget that people grow food everywhere. But the analysis mostly centers around like 4 countries because those are the big exporters of food. But the issue is, and it's something that you don't really hear about too often, except in cases like you just mentioned, where you're having sort of spiraling food insecurity and geopolitical problems that are causing local production to have shortfalls, is that people are going to eat literally on ahead of anything else. So when you're analyzing wheat markets, for example, it's easy to forget about African consumption, because even in countries in parts of Africa where they get most of their calories from cassava, for example, if they can't produce food locally, they're going to have to import food from somewhere else, and it's going to be the number one thing that they try to get their hands on, whether themselves or through the World Food Program or something like that. So there's just big blind spots because it's too big to analyze. There's too many interconnected parts. There's too many countries. No one's doing deep analysis of, food production trends in the Sudan or Somalia. But those people eat also, and they eat almost as much as anyone else.
That's a challenge. I bet I can find somebody who's doing very good research about food production in Sudan, but they're probably in a PhD program somewhere and have nothing to do with kind of the broader media narrative, which, unless you have something to do with Donald Trump or something like that these days, you're probably not going to get to the front page. But this actually also ties back to the first part of our conversation about China with that China with the trade surplus, United States with the trade deficit. And this is where I would say that manufacturing, food, raw materials, all these things are mirror images of each other. And I think there are these silos where the manufacturers don't understand that they're part of a bigger world, and the food producers and the farmers don't understand that they're also part of a bigger world too. And these big food exporting nations, the reason they export abroad is because the price of food domestically that gets sold has been driven down so much that the only way for those farmers to make ends meet is to export things abroad. So you have this agricultural complex and governments who go to farmers and say, yes, you want to sell abroad. You want to sell this food abroad. And it sounds good, but what ends up happening is a country like Egypt, which shouldn't be able to support a population of 100 plus million people in the Nile River, suddenly there's 100 million people in the Nile River because they got used to importing all of these cheap calories from abroad. And this is what I say about resetting of the global economy. It's one thing to say, oh, we're headed towards deglobalization. We're headed towards a multipolar world. I say these things all the time, but it's not going to happen with a snap of your fingers. And it's going to happen in really disjointed, really disruptive ways. Because if you actually start to change some of these systems, these food exporters, they have to go from maybe exporting food to maybe servicing their domestic market, maybe for it actually being cost effective for them to grow high quality food for their own markets rather than having to export it abroad. Maybe they have to move up the chain and do ingredients or even their own food products and things like that. But that's not the way the system works right now. And that's why I say like the focus on China rebalancing. China can't rebalance any more than the United States can rebalance, than a country in Africa that's eating cassava can rebalance. Like all these things, for better and for worse, sort of have to work at a global level. And if they're not going to work at a global level, you're going to see disruption. So I'll get off my soapbox there. And I mean, there's honestly, like, we haven't even really scratched the surface of what's going on geopolitically in the world right now. It's, maybe we'll round out this conversation, Rob, with just sort of a general check-in on South America. Because I think we've done a pretty good job. I promised at the beginning of the year the podcast would focus more on sub-Saharan Africa and on South America. And I think we've done a good job with that. But it's also been a particularly volatile week in South America. In Ecuador, the Congress has been dissolved by, I'm looking to see whether it's President or Prime Minister Lasso. I'm pretty sure it's President Lasso. Yes, President Lasso, no relation to Ted Lasso, ladies and gentlemen. But he dissolved Congress. The Ecuadorian military and security forces seem to be on his side right now. Ecuador is not a hugely important country. They export some oil. They actually are one of the largest exporters of frozen shrimp and also bananas. So maybe stock up on your frozen shrimp and bananas and things like that. Argentina is sort of hurtling towards the next phase of its inflation crisis. Inflation surprised. I don't know why we're surprised that inflation was on the upside in Argentina, but it's over 100%. We're talking, some of the worst inflation data we've seen in Argentina going back to the early 1990s, which is really saying something considering Argentina's economic history for the past 30 years. So that's going on. And then signs in Brazil are a little bit better. Maybe I'll leave it to you to talk about some of the things you've seen in Brazil with the service sector and sort of some surprisingly strong numbers out of Brazil. It's maybe the silver lining of the story.
Yeah, and I think drawing that comparison between Brazil and Argentina in the 1990s is an interesting one. I think a lot of people were looking at what's been happening in Brazil and predicting that they were going to have major volatility and unrest and inflation, especially around the elections and all the kind of craziness, Brazil's January 6th moment, that sort of thing. You haven't really seen that. That's a real testament to the progress that Brazil has made and maybe Argentina has not in the intervening 25 years. Because in an alternative scenario, they could have very well ended up in a 1990s kind of inflationary environment. But no, actually the data is going from strength to strength. I guess the first thing you mentioned, the service sector. So in full disclosure, we've been bullish on Brazil, and we own both tactical and long-term positions in Brazilian equities. And the equity market has been very, very strong, pretty broadly in Brazil, and largely because growth has been really, really picking up. So the service sector, just the numbers came out for March, and you're seeing growth on top of growth. So the growth in Brazilian services, which is kind of a broader measure of everything that's non-manufacturing, so retail, restaurants, all of that sort of thing. The growth number was up 6.3% in March, which was above expectations for 5% growth. And as I mentioned, it's growth on top of growth. So that's against last year, it was up 11.6%. So you're seeing 6% growth on top of 12% growth last year. So you're really seeing, coming out of COVID in the last 2 years, this acceleration as things in Brazil pick up more and more and more. We've talked about kind of the tailwind that Brazil appears to be getting from the globalization, especially in IT, of hiring and services. Just to show that I'm not totally crazy about that, there was a piece, I think it was either in the Financial Times or the Journal in the last 2 weeks, pointing out exactly this, that Brazilian tech workers are doing extremely well because of these issues where they're picking up jobs from the US and jobs are being outsourced because they have that advantage and they're very, very skilled and it's cheap, it's in the same time zone, et cetera, et cetera. So all of these things are really coming together. The other thing that I found interesting in Brazil was, I think, Brian Winters, who writes for the America's Quarterly, he pointed this out, that there was a survey done of the Brazilian electorate, and the survey results were remarkably normal. So among other things, they questioned people about their voting intentions and what their priorities are. And the takeaway from the survey was, maybe 25% of the electorate are hardcore, Bolsonaro supporters who put ideological matters first and foremost when they're making decisions. Pretty much everyone else is just voting based on the economy, which is what you want to see when things are stabilizing and normal. And Brazil is not experiencing 100% inflation like Argentina. They're experiencing 6% inflation, and it's coming down, and the central bank is, has things under control, and all of this is positive. I don't think these negative scenarios that some people were worried about a few months ago, even, there's much evidence of them playing out.
Yeah, no, it's funny. The two tweets or reports that I put out that have gotten the most pushback in the last 6 months. When I put out a thing about why we were bullish Brazil, I got some US macro investors who they were trying to light me up on Twitter about what a moron I was, like just telling me how stupid I was and how I didn't understand anything and that Brazil was terrible and things like that. And I actually enjoy hate mail. Hate mail means I'm doing my job right. I've hit a nerve. But what was surprising to me was just the level of anger from some people who are like, Brazil has been, its potential has always been there and it's never going to realize its potential. I think there's a quote that was mistakenly attributed to Charles de Gaulle saying Brazil will always be the country of the future. I'm paraphrasing it, something like that. And he didn't even say it, but there's this idea that like Brazil's never going to realize its true potential. The other one, by the way, was last week I posted, there's a terrible article in the New York Times about how apparently they're still searching for witches in India. And it's a very, very small number. It's sort of weird that the Times led with that and things like that. But still, like Indian government data says there have been like 1,000 or 1,500 cases of people tracking down witches in like random parts of India. And I said, this is really bad in 2023. And the Indian Twitter community was just like, oh, that's propaganda. That's not true. And I was like, God, like it's your own government's data. Can you just say that this is bad, but it really doesn't define the billion plus people that are in India? I don't say one bad thing, a little bad thing about India, and boy, do their social media people come after you and do it that way. But bullish on Brazil. I don't really know how to account for just how bad things are in Argentina and why things keep getting so much worse. I mean, if you look at a chart of inflation with Argentina, I mean, it's really striking going back to sort of 1991, I think October 1991 was the last time that inflation was in triple digits. So all of the drama you've heard about Argentina going back to the early 1990s, like inflation's never been worse. And so the government has come out and it said it's going to intervene. Or the central bank is going to intervene to try and prop up the peso. They jacked up interest rates by something like 600 basis points. One of the most interesting things was they've now eliminated tariffs on the import of food, which also gets back to our conversation as well. Argentina is a major food exporter, and up until now, the government's been trying to intervene to try and make sure that food prices stay low in Argentina. Now they're going the exact opposite route. They're just going to get rid of tariffs, and they want people to import. That has an interestingly dovetails with the United States a little bit, because you mentioned our soybean thesis. Part of that was, hey, like there's plenty of soybeans out there. Maybe the United States will start importing soybeans from Brazil. I got called crazy for that. Starting to see like there's some imports of soybeans from Brazil. You even put an article on the Knowledge platform just this morning that said because of the Mississippi River drought, there's even the United States is importing some wheat from Poland via Florida. I mean, just sort of mind-blowing stuff, and goes back, but we don't need to go back down the food rabbit hole. But just to say, even if Brazil wasn't doing as well as it is in all these other areas, its one key rival and main competitor, Argentina, it's just not there. I mean, it's basically it's failing to maintain itself, and it's looking at as the most serious economic catastrophe it's had in the last 30 years. So, I mean, put all those things together, it's good for Brazil. It might be bad for the region in general, though. And if I was advising a strategic decision maker in Beijing, I'd be looking real hard at Argentina right now and wondering what intervening and offering them some of that nice trade surplus and all this capital and money that I have lying around. I think there's a relationship to be bought there if you're thinking of this in just purely zero-sum terms. I don't know if it'll go that route necessarily, but that is a reason I think that the United States really needs to be concerned about what's going on in Argentina. Because if you ignore it, or if you try and square peg round hole them into whatever the IMF thinks is best for them, we've seen this movie before. You see it in Cuba, you see it in Venezuela, sort of El Salvador, Nicaragua. I mean, but Argentina is much more important in some ways than a lot of those countries. So that's a little bit rambly, but I don't know. Do you have anything to say about Argentina and the fact that it's a basket case?
I guess all I would say is that you tend to see these things become self-reinforcing when you talk about volatility and uncertainty, right? I think all of this comes down to uncertainty in many ways. And in many ways, that's what inflation is all about, where, people often ask about the difference between inflation and hyperinflation. And those are two terms that are often confused. And this is really the difference. Is hyperinflation is a matter of uncertainty or lack of trust in the broader structures of an economy and a society. I think that's really what you're seeing more and more in Argentina. Whereas, if you look at a country like Turkey, their 80% inflation is not really the same kind of inflation. That's true inflation. Whereas Argentina, even though the numbers are close, I think you could classify it as hyperinflation, because it's crazy town as opposed to just price passing through. And the comparison with Brazil is really instructive, because they've had a self-reinforcing spiral in the opposite direction, in the positive direction, where normality begets a desire for more normality. Normality by Brazilian standards, it's still kind of a wild and crazy place. But, just to take, that's very high level, just to take a bottom-up example of what we're talking about. And if you want a good gauge of the Brazilian middle class and upper middle class, so one of the big positions that we own in our tactical equity strategy is Arcos Dorados, which is the franchisee of McDonald's restaurants in all of Brazil. They do all of the McDonald's, and they just reported their 1Q numbers. They blew out the number, very good results, and their same store sales were up 34%, of which they had something like high teens inflation, because the inflation from last year is still getting passed through. Mm-hmm. But they had double-digit traffic growth at their McDonald's restaurants, despite the inflation, the price increases that you saw Double-digit growth in Brazilian households going to McDonald's. And that sounds so silly, but going to McDonald's is like, that's a very, I don't want to say very aspirational, but it's an aspirational thing that people do. Like McDonald's is fancy, relatively fancy in Brazil, depending on where you are. Maybe not in Sao Paulo, where there's sort of, little niche fancy burger places. But in most of Brazil, going to McDonald's is something you do when you have money and you're feeling good. And the fact that they have double-digit traffic growth this year relative to last, despite 15% higher prices, that's a sign that things are going right.
Well, and it also, I keep on saying that, Brazil is the country in the world that reminds me most of the United States. In part because I'm sure that, there are parts of the United States where going to McDonald's or going to Waffle House is also something you do when you want to do something nice, when you want to spend your money. That might sound crazy to, some of the more affluent listeners of this podcast, but go to parts of the country where like McDonald's or Waffle House is the only restaurant in small towns. And you'll see that like people, or Cracker Barrel, if you're really doing well in that part of the world, like things are pretty good. But now I'm waxing. If you're not careful, I'm going to wax philosophical about why Cracker Barrel mac and cheese is the best in the world. Before we get out of here, Rob, I'll just ask: is there anything we didn't cover that you wanted to cover? Emre and I covered Turkish elections, but we can talk about that more if you want. Philip Orchard is hopefully, knock on wood, coming on to cover Thai elections later today, and we'll try and push that out, if not on the same day that we put this podcast out, fairly soon after that. So those are two important ones, but I feel like we've got you covered there, listeners. But is there anything else out there that you think we missed that we absolutely should be talking about before we say goodbye to the listeners and let you get to whatever it is the French are celebrating today?
No, I mean, I think those are the big ones. Turkey, we just took in full disclosure again, we just took a small tactical position in Turkey to start getting our foot in there. We've talked recently about how we were sort of sitting out the elections and we didn't have a position. Well, now we do. But I'm sure you and Emery will have a full discussion of that.
And now is a good time to plug. I sent you a draft of the In Focus piece on Turkish elections. So if you want the nitty gritty, full report on what happened with Turkish elections, this is your time to subscribe to the Knowledge Platform, folks.
Yeah, that's right. So any institutional people out there, fund managers who listen to this, wealth managers, corporations that need to deal with Turkey, Jacob has the full analysis and lowdown in his most recent In Focus piece, which is, I don't even want to say hot off the presses. It's still, we need to fire up the presses and get it on the press. But that's going to be out in the next day or so. So yeah, Turkey, Thailand, I think is really interesting, both from a, Chinese perspective, but also in terms of rice and some of the things we were talking about. They actually, just not to get back into rice, but they just announced in Thailand that they are recommending that they only plant one crop of rice in this upcoming season rather than two, which is a big deal, and that's contributing to rice prices as well. So watching Thailand and this upcoming podcast is going to be pretty important for a lot of things that you may not be thinking about too much.
Yeah, I'm looking through the Knowledge Platform right now, and I guess the last thing that I would put in listeners' mind before we say goodbye, I talk a little bit about this with Sim and the Ukraine podcast that is coming out on Monday, but two issues related to Germany, which in some ways cut against our short Germany position in the macro strategy, Rob. The first was, I thought it was a big deal that Germany said over last weekend that they were going to pony up 2.7 billion euros in military support for Ukraine coming forward. It was accompanied with Germany's defense minister reiterating that Germany will do, quote unquote, whatever it takes to make sure that Ukraine wins the war. For some perspective, listeners, that Germany basically just promised in one press release the same amount that it's given to Ukraine during the entire war so far. And just, another way to benchmark that is the month before the war started, when it looked like Russia was burying its teeth. What did Germany do? It sent Ukraine 5,000 helmets because they didn't want to send weapons because they were worried it was going to mess up their relations with Russia and natural gas and Nord Stream 2. So we've gone from, we can't send you weapons, but we'll send you 5,000 helmets to, here's 2.7 billion euros and we are committed to you to winning this war. I thought that was a big deal. The second part, though, was Rheinmetall, which is a German defense company, announced that it's formed a JV with a Ukrainian state-owned conglomerate to build and repair tanks. That's coming from Handelsblatt. And I thought that was important just because these German defense companies, they really haven't had a German military to build products for. Maybe they will here as we get into the reawakening of German geopolitics and German sovereignty and German military strength. But I thought that was really important because German business interests now seem to be looking at Ukraine as an opportunity. So even German companies are sort of coming to terms with the fact that, okay, like Russia, that's closed for us right now. But if Ukraine wins this war, that could be a major opportunity for German industrials, for rebuilding that country, for cheap labor, if you want that, or in this particular case, for repairing and building tanks. So that is another thing that I think I would be remiss not putting in your mind. And it happened like over last weekend. Again, it was one of those things that on Monday you got this deluge of developments. That was one that I wouldn't want to get lost in the shuffle.
Well, in an environment where Germany is, worried about its competitiveness, the notion of having a country the size of Ukraine that it can further extend its supply chain tentacles into, in much the same way it has into other parts of Eastern Europe, must be pretty enticing.
Well, I joked I was joking. I forget who I was joking with, but one of the analysts on our team, he's sort of the opposite of me. He's the uber German skeptic, and he's always like, 2.7 billion, whatever. Like he always like sort of reins me in line. But he's been out this week, so there's nobody to rein in my unbridled optimism about the German economy right now. So you're getting it unvarnished here without him telling me what a moron I am. But besides that, I would just say, often when I give presentations or speeches, or I shouldn't say often, the last time I gave a presentation or speech, I sort of put up what was conventional wisdom in the 1980s and 1990s and what is conventional wisdom today. And that's relevant because the conventional wisdom on Germany, for some reason, is always negative. So when West and East Germany were going to reunify, the sort of mainstream narrative was it's going to take West Germany generations and billions of Deutschmarks to do this. It's going to be a huge drag on the economy. The exact opposite was true. It was a shot in the arm to the German economy. They did it relatively quickly. My favorite one is to put the cover of The Economist in 1999, calling Germany the sick man of the euro, and say, Germany, the economy's not doing well, it's not going to go well. Well, if you had listened to that, like Germany then had its, third German economic miracle and the export complex and all these other things that happen after that article gets published. And I just detect a similar level of pessimism on a long-term level about Germany in the narratives and in markets right now. And I can make the argument, like we can talk about demographics, we can talk about red tape, we can talk about Germany's lack of self-assurance and its historical memory and how historical memory prevents it from being innovative in some ways, ignoring nuclear, but still going after coal and trying to get natural gas into EU green. Like I can make the argument that Germany's not going to do well here over the 5-10 year time horizon. I would just say that, historically, it's usually not wise to underestimate Germany when it hits a moment of extreme geopolitical change. And I think that's what Germany's facing right now. So maybe I'm wrong about that, but maybe my personal history colors it, but I will not underestimate Germany, and I would encourage listeners not to as well.
Just to cap that off, on the innovation side, everyone thinks of innovation in terms of software, basically, because that's now we just assume that that's the only place where technology advancement is happening. And Germany is not very good in software, but as we do a ton of research and we work with a group called Quant IP in Germany that does machine learning based analysis of technology, process, intellectual property, patent portfolios and stuff. As part of our innovation strategy and our innovation research that we have as part of our knowledge platform. And that's a long-winded intro to saying Germany is kicking ass in the areas that are going to matter in the next 15 to 20 years. Hydrogen, aviation, materials, don't discount them. And we can talk more about that in a future one. But I think that's an area of underappreciated strength that we have identified for sure.
Yeah. Well, on that note, I think that's plenty. Rob, thanks for making the time, and go enjoy the French holiday. Pour one out for me while you're doing it.
I got to go take care of a baby. That's why I got to get out of here.
Well, declare your own French holiday tomorrow. Say you identify as an American who takes the French holiday the next day. We appreciate you. We'll see you soon. Thank you so much for listening to the Cognitive Dissidence podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur.